Welcome to an episode of Follow the Money. I am your host, Michael Maduell. This is my first official video podcast for the Follow the Money show. The opinions of the show are of myself and not of SWFI. Well, did anyone watch the Golden Globes last night? I sure didn't, but I heard Oprah was quite the show, and people are talking about her running for president. Now on to some more serious issues in terms of sovereign wealth funds, because this channel is about sovereign wealth funds and pensions. Are some issues of the Sovereign Wealth Quarterly. Again, if you don't have a subscription, you can go to our website at swfinstitute.org and you can subscribe. And it includes access to our online website and publication and research here. So let's talk about some of the news today. There's a lot of interesting things going on. I'll talk about our healthcare report that just came out last night, but I do want to cover some interesting topics. So let's talk about Asia. First thing is the People's Bank of China has announced that foreign reserves grew by $20.7 billion this month. So right now, Chinese foreign reserves are $3.14 trillion as of December 2017. For the whole year, Chinese foreign reserves have went up $129 billion. And the reasons are manifold. One is that China's put tighter capital controls and policies in place. And they've also kind of gently suggested to these large Chinese state-owned enterprises / private companies to slow down on their corporate M&A deals overseas, meaning let's stop buying as much real estate in Manhattan or some of these semiconductor deals that are now being stopped by CFIUS, which is the Committee for Investment. It analyzes foreign takeovers, and there's been a kind of a kibosh on that with the Trump administration that's not so keen on Chinese companies investing in technology companies in the United States. So Chinese foreign reserves, again, a bit of a slowdown there. Also, kind of staying in that realm, an Iranian oil tanker crashed into a cargo ship, and apparently there's missing people there. So that's kind of an issue in the oil trade markets. That's sort of a headline that's kind of coming up here. Also, we have the Apple. The Apple products are vulnerable to the meltdown vulnerability. That is a well-known story. A lot of issues there. And why am I covering the story? It's because Apple is one of the most popular stocks that are owned by pensions and sovereign wealth funds. In fact, two large investors, a activist hedge fund called Jana Partners and Apple, recently penned a letter to Apple's board of directors, and this is regarding smartphone addiction, right? Basically, everyone's glued to their cell phones. Everyone loves surfing the web and looking at things and, going on Snapchat and Facebook and other forms of social media. But what's fascinating is, and what's interesting is how is it affecting children? And interesting, CalSTRS, the California State Teachers Retirement System, and Jana Partners, again, penned this letter, and they implored Apple to look into basically smartphone addiction, because there's been numerous academic studies covering this. And also there should, they suggest, there should be a high-level executive monitoring the situation and being more proactive versus something happens 10 years from now. There might be a government regulation. There might be a change. So Apple shareholders are very keen on this. Now, there's been pushback. I believe I read an article somewhere, Jim Cramer's saying that, hey, man, parents have to be responsible and monitor their own kids' iPhone behavior, right? But if iPhones are being consumed and marketed, just like with the days of cigarettes and Joe Camel, it's good for companies to be on the forefront of this. And Apple's been on the forefront. They've been trying to tackle issues like this with supply chain management and environmental issues, especially with the development of the iPhone, iMac, Mac, iPad devices, Apple Watch devices, right? Because many of those products are made in China, and the controversy surrounding those workplace practices and everything else. I'm going to pivot here and talk about our conference coming up. We have a conference coming up February 20th through the 22nd. It's a 3-day event at Hotel Casa del Mar in Santa Monica, California, United States. Again, it's February 20th through the 22nd. If you want to learn more about it, just go to iinvestorforum.com. iinvestorforum.com. You can go to the contact page and reach out to our event teams, and they'll tell you more about it. But again, we are partnering with the World Ocean Council. So again, the first 2 days have a strong topics about blockchain, asset allocation, investment strategies, real estate, infrastructure, anything related to what asset owners really want to talk about. That's on day 1 and day 2. And day 3, we partner with the World Ocean Council, and we're going to talk about the blue economy, aquaculture, the Caribbean islands, and what's going on with renewable investing there. We're going to talk about Arctic seas and some of the geopolitical strategies behind that. So again, if you are a fiduciary, if you're a sovereign wealth fund or pension, this is a great event. In fact, I believe we have almost over $2.5 trillion worth of sovereign wealth fund / pension capital signed up for the event. And that's what I'm talking about the private capital from my notes. But again, this is a very high-level forum. We do only about 3 or 4 events a year. And it's just really about bringing people together, talking about these issues, and really, exploring these topics. We also have TED speaker Aubrey de Grey talking about life extension and current treatments and trends. So again, it's just a really diverse, I guess not the typical finance conference where it's, hey, I'm going to talk about A, B, and C, and this is product A, B, and C. Nothing like that. This is pretty much what are the big trends coming out, where the smart money is moving, what types of scenarios or what channels or avenues are asset owners accessing these types of strategies, how are sovereign funds playing a bigger role, or public pension funds playing a bigger role in funding startups, funding biotech, funding ocean investments, and those sorts of opportunities. So if you want to learn more about it, it's iinvestorforum.com. That's iinvestorforum.com. So let's talk about this direct healthcare investment report. My staff put out this report, the research team, on direct healthcare investments by sovereign wealth funds and pensions. And what's interesting is that there's been an increase in this. So more and more pensions and sovereign funds are going direct, backing startups, backing pharmaceutical companies that have promising degenerative therapies to solve those conditions. At the same time, there's been a tremendous amount of capital flowing into mature healthcare businesses, firms that already have quite a bit of market share. In fact, there's been a lot of open market purchases by Norway Sovereign Wealth Fund, GIC, the Canadian pension plans on mature healthcare companies, whether they're in the United States, Europe, or Asia, especially in Japan. And again, if you want to learn more about this report, you can go off our website, sws2.org. The report is available to our subscribers, complimentary, and it's also available for a single subscription, for a single purchase as well. So just let me go over some of the highlights of this report. In 2014, there was about $8.02 billion of direct healthcare investments made by sovereign wealth funds and long-term pensions. In 2014, $8.02 billion. By 2016, that number jumped to $31.35 billion. That's a massive increase in healthcare spending. Now, part of this can be contributed to that more wealth funds and pensions are investing more into equities, and there's an open market purchase bias there. But what I'm trying to get to is that sovereign funds and pensions are becoming larger players in the world of fund commitments, capital investments, etc. Traditionally, venture capital, corporate venture capital, they still dominate the healthcare space, but wealth funds and pensions want to get in on many of these deals, and a lot of biotech, whether you're pharmaceutical, healthcare, digital startup, or some sort of anti-cancer therapy company, a lot of wealth funds are at the door waiting to allocate their capital in these opportunities. Now, how are wealth funds and pensions finding these opportunities? Well, obviously there's many avenues. They're partnering with investment firms that have a lot of expertise in this space. So, for example, the Alaska Permanent Fund Corporation, they've been backers of Juno Therapeutics and Denali Therapeutics, and they work a lot with Arch Venture Capital and Crestline investors, right? Some of these sovereign wealth funds and pensions, they have investment banks that they talk to. Our conferences, there's a reason why many asset owners come to our events, is to get intelligence and information on this sector and to learn more about it and to see what deals are getting funded. So there's many ways. In fact, we've seen an increase in that asset owners are really spending a lot of time doing their own due diligence, going out there, whether it's going to conferences, setting up meetings, through road shows. A lot of asset owners are actually being a lot more proactive than relying on the traditional channels of deal funding. But let's be straight here that wealth funds like the Abu Dhabi Investment Authority, Temasek Holdings, GIC, they get pitched every day. I mean, there's pitch books always on their desk. Everyone wants to, tap into that capital. And that's why they're very highly selective. And there's a whole middle tier of sovereign wealth funds in size that don't get as much, I guess, love and attention compared to the larger sovereign funds. So this healthcare report, and again, I don't want to spoil it. There's a lot of good nuggets in here. The data is from our transaction database that tracks all these certain deals in the sovereign wealth fund and pension space. I think it's pretty much the only one dedicated out there. And again, I don't want to spoil the report, but the big theme is that a lot of money is going into healthcare. A ton of money is going into healthcare investments. And it's an area where it's uprooting some of the traditional sources of funding. Okay. Another deal that just hit the wire here that they wrote about was the Lego family office bought a stake in Veline Group. I hope I'm saying it right. It's a Swedish company. This company, Kirkby, is basically the family office of the founders of Legos. And they bought this Swedish firm from KKR as a 49.8% stake. The rest of the company is going to be owned by the Pervin family of Pervin Novo Invest AB. That is their family office holding vehicle of Velan stake. Okay, that's a deal that just closed, I believe, yesterday. Another story that I want to talk about is Neiman Marcus retail, right? So there's been a lot of sovereign wealth fund capital and pension capital going into two industries. One is e-commerce, because how consumers are purchasing and buying goods is different. You can talk to your aunt, your uncle, family members, spouse. Hey, did you buy my Christmas present in person or online? And I would say a lot of them are using services like Amazon or Walmart or Jet, etc. So there's a drive towards e-commerce, and wealth funds and pensions are recognizing that. That's why they're plowing a lot of money into that sector. They're putting a lot of money into whether it's real estate, the last mile and logistics, or directly into e-commerce backed startups. For example, in Saudi Arabia, you have Noon, which is going to compete against Amazon and other online retailers there. In India, you have Snapdeal and a plethora of startups, and many of them are backed by Asian sovereign wealth fund capital, such as GIC and Temasek Holdings. Okay, so that leaves us to luxury retail, Neiman Marcus. Now, in 2007, 8, 9, 10, a lot of buyout firms are saying, hey, these retailers are looking pretty cheap because the economy after 2011, 12, 13 started to pick up again. And so a lot of Canadian pension money partnered with private equity firms, basically saying, hey, we have a lot of these opportunities, whether it's a dollar store on the lower end of things or on the high end of things. Neiman Marcus, hey, we should buy out these companies and make some money. Well, they're not panning out that well. The 99-cent store, other kind of retail outfits being backed by Canadian pension money has been a bit disastrous. In fact, for Neiman Marcus, a lot of the debt's being, I believe from sources, that it's going to be restructured. And Neiman Marcus just let go of their CEO, Karen Katz. They brought in a gentleman from Ralph Lauren who's going to try to turn it around. But again, just in general, a number of trends are happening. One is the e-commerce trend, buying on demand. So there's less need of malls, right? You've seen Sears, Kmart, Macy's, etc. A lot of stress there. And Neiman Marcus, right? people are actually, middle to high end consumers are actually almost becoming a bit agnostic on name brands. This wasn't like before, right? I mean, if you were a young person and you wore Abercrombie and Fitch, trendy clothes make you look cool, right? I don't think people are into brands as they were, I guess, 10 to 15 years ago, just from talking to people and who wore these types of clothes. But kind of detracting here, Neiman Marcus. They were bought out by, I believe, looking at this right here, Neiman Marcus was bought out by Ares Management and CPPIB, the major large Canadian pension fund. And so it'll be interesting to see how this plays out and how the debt gets restructured in this transaction. But Neiman Marcus, I mean, has been through a heck of a time. They tried to IPO 2 times in the last 3 years, and just been saddled with buyout debt. And again, that's sort of the issue with buyouts is that, it might look good on a spreadsheet, but you have to look at the different market cycles. And not only that, you also have to look at how the revenue is generated. And in this instance, for retail, it's consumers. And what are the consumers' tastes and preferences? And how do consumers want to buy things? Do they want to go to the store, feel it out? Or can they sit down on their desk and order something, try it out, and if they don't like it, ship it back out, right? So the nature of consumption is changing in the United States, Europe, Asia, and elsewhere. So, again, this is an episode of Follow the Money. I'm going to keep this short. I might try to expand the time in the future. If you like this show, Follow the Money, or if you want to see me do more of these, please click on the subscribe button below. I'm also going to have this featured on followthemoneyshow.com and our other channels. Right, we have over 45,000 people on our email distribution list. We have a very wide network. Interesting enough is that most of our audience, actually the majority of it, a slight majority of it, is outside of the United States. So we're very well recognized in Europe, Asia, and in the Gulf. But again, if you like what I'm doing here, please subscribe to the button below, and any kind of comments or something, feel free to put them in the notes there. I am a bit new to this, but I feel that using these new forms of media other than print and email, I think could be very beneficial. And again, my goal on the Follow the Money Show is to provide you a little bit of entertainment, but insights onto what I'm seeing in the marketplace, insights to what people are telling me from my trusted sources, and basically, follow the money, right? Whether it's wealth fund, pension, endowment, family office money. These are all sectors that, we have coverage over, and people pay for our data. People pay for our content. They pay for our access and intelligence on these investors. And I'm just trying to share that with the audience here. And, but one more thing, I'm going to plug in one more thing is, again, if you want to go to our conference in Santa Monica, it's iInvestorForum.com. Our Asia conference will be in June 5th through 6th in Tokyo at the Andaz. And our conference in Europe is going to be in Rome in the fall. So hopefully we can meet one day, and I look forward to it. And again, if you ever want to learn more about wealth funds and pensions and long-term investors, you can always go to our website at swfinstitute.org. Have a wonderful day. Take care.